Within 72 hours of the court ruling, something unusual happened in financial capitals far from Washington. Analysts in Beijing's Ministry of Finance began circulating internal assessments. Strategists in Moscow's central bank convened emergency briefings. Sovereign wealth funds in Abu Dhabi and Singapore quietly tasked their research teams with a specific question. And none of them were focused on Trump's legal victory. They were analyzing what the ruling had inadvertently exposed about American financial power itself. Here's the paradox. How does winning in court reveal a weakness? The answer lies not in what the ruling decided, but in what it made visible. The very fact that these arguments had to be litigated, that certain financial authorities and mechanisms were debated in legal filings, validated by judicial reasoning, and documented in court records, revealed fault lines in America's financial architecture that had been theoretical until now. What Trump won legally, America may have lost strategically. For decades, American financial dominance has rested on something more subtle than aircraft carriers or GDP figures. It's been built on institutional constraints, behavioral norms, and self-imposed limitations that created a specific kind of credibility. Global markets trusted that certain things simply couldn't happen, not because they were economically impossible, but because institutional architecture made them unthinkable. This ruling demonstrated that those constraints may be more discretionary than the entire global financial system had priced in. We're not talking about temporary market volatility or domestic political controversy. We're talking about foundational assumptions underlying the dollar's reserve currency status, the pricing of $26 trillion in Treasury securities, and the architecture that makes global finance function. To understand what weakness was just exposed, we need to understand something most people miss. America's financial power has always depended on strategic self-constraint, not just economic might. And that constraint just became negotiable. The case centered on executive authority over extraordinary fiscal mechanisms, specifically, whether the president possesses discretionary power to reinterpret debt ceiling constraints, restructure Treasury obligations, or invoke emergency financial authorities without explicit congressional authorization. Trump's legal team advanced a sweeping theory of executive power rooted in Article 2 of the Constitution, combined with statutory interpretations of the 1977 International Emergency Economic Powers Act and certain provisions within the Federal Reserve Act that grant the executive branch latitude during financial crises. They cited historical precedents, Roosevelt's 1933 gold confiscation under Executive Order 6102, Nixon's 1971 closure of the gold window, and post-2008 invocations of emergency lending facilities. The argument was clear. Executive financial discretion during emergencies is constitutionally embedded and historically validated. The plaintiffs, a coalition of state attorneys general and fiscal policy organizations, argued the opposite. They claimed that such authorities, if they existed at all, were constrained by the Debt Ceiling Statute, the Administrative Procedure Act, and constitutional separation of powers. They warned that validating these theories would grant the executive unilateral control over debt management, potentially enabling Treasury payment prioritization, selective default mechanisms, or even monetary financing schemes that circumvented congressional appropriations authority. The court ruled in Trump's favor on the core constitutional question. It found that during periods of fiscal emergency, the executive possesses inherent authority to manage debt obligations and Treasury operations beyond strict statutory constraints, provided actions fall short of explicit constitutional prohibitions. Certain discretionary powers were confirmed: emergency debt restructuring, payment prioritization during revenue shortfalls, and expanded interpretation of what constitutes permissible Treasury and Federal Reserve coordination. But the ruling's legal scope was narrower than what the litigation revealed. Court filings exposed contingency planning documents describing break glass financial options, mechanisms for bypassing debt ceiling constraints, protocols for prioritizing bondholders over other obligations, and theoretical frameworks for monetary operations that blur the line between fiscal and monetary policy. These weren't hypothetical academic exercises, they were documented government contingency plans, now part of public court records. What the ruling legally permits is one question. What it revealed about the architecture of American financial crisis management is another entirely, and that revelation is what's now circulating through foreign finance ministries. American financial dominance was born not from economic superiority alone, but from institutional architecture. The 1944 Bretton Woods Agreement created something unprecedented, a global monetary system built on rules, transparency, and binding constraints. The dollar became the world's reserve currency not simply because America possessed the largest economy, but because the system was designed with credible limitations: gold convertibility at $35 per ounce, fixed exchange rates, and institutional mechanisms that theoretically constrained American discretion. That architecture began crumbling in August 1971 when Nixon closed the gold window. By every historical precedent, this should have destroyed dollar hegemony. A currency that abandoned commodity backing while running fiscal deficits and fighting an expensive war had no claim to reserve status. Yet the dollar not only survived, it strengthened. Why? Because institutional credibility partially substituted for gold. The Federal Reserve, granted operational independence in practice, if not statute, demonstrated commitment to price stability. Treasury operations remained transparent and rule-governed. Markets came to trust that American financial policy, while no longer gold-constrained, remained institutionally constrained by norms, procedures, and separation between monetary and fiscal authority. The Volcker era cemented this credibility. When Paul Volcker raised interest rates above 20% to break inflation in the early 1980s, he inflicted severe economic pain, demonstrating that institutional commitment to monetary stability could override short-term political pressures. This wasn't just about defeating inflation, it was about proving that American financial institutions operated according to principles rather than expediency. The 2008 financial crisis tested these boundaries dramatically. The Federal Reserve deployed emergency lending facilities that hadn't been used since the Great Depression, effectively creating trillions in liquidity through unconventional mechanisms. The Treasury guaranteed money market funds, backstopped major financial institutions, and intervened in markets with unprecedented scale. Yet credibility held largely because actions were conducted transparently, with congressional authorization where possible, and with consistent communication about objectives and constraints. The debt ceiling crises of 2011 and 2013 revealed something different. Certain fiscal constraints existed more as political convention than legal absolute. Markets watched Congress approach default deadlines repeatedly, each time resolving the crisis at the last moment. Sophisticated observers understood the ceiling was ultimately political theater. Congress would never actually allow default. But the assumption persisted that responsible behavior would prevail because institutional norms demanded it. Compare this to alternative models. The British pound's decline from reserve currency status wasn't sudden collapse, but gradual erosion following repeated devaluations in 1949, 1967, and the early 1970s. Each one demonstrating that constraints were negotiable when politically convenient. The Japanese yen never achieved reserve status despite Japan's economic size, partly because markets never fully trusted the institutional independence of Japanese monetary policy from political pressures. Emerging market currency crises throughout the 1990s and 2000s followed a consistent pattern. Credibility collapsed when institutional constraints, central bank independence, fiscal rules, regulatory frameworks were revealed as discretionary and subordinate to political authority. The historical lesson is unambiguous. Financial hegemony requires credible commitment to predictable rules and institutional constraints that operate independent of immediate political incentives. Economic size matters, but institutional credibility determines whether that size translates into monetary dominance. History shows that financial dominance doesn't end with economic decline. It ends when the institutional constraints that create predictability are revealed to be optional. And that revelation just happened. Section 4. The Hidden Strategic Story. The weakness exposed isn't about American economic capacity, it's about the institutional foundation that made that capacity credible. The ruling revealed that constraints markets believed were legally binding are actually discretionary, subject to executive interpretation, and dependent on political will rather than institutional structure. Consider what this means for Treasury markets. U.S. government debt is priced as the global risk-free asset, the baseline against which all other investments are measured. That pricing rests on an assumption that institutional constraints make default, selective payment, or monetary financing effectively impossible regardless of political circumstances. But if the executive possesses legal authority to prioritize certain debt payments over others, to reinterpret obligations during emergencies, or to coordinate with the Federal Reserve in ways that blur monetary and fiscal policy, then that assumption requires revision. The repricing doesn't happen overnight. It happens in increments measured in basis points across trillion-dollar markets. A few basis points on long-dated Treasury yields translate to billions in additional annual borrowing costs. Multiply that across decades of debt rollover, and the fiscal implications become structural. Then there's Federal Reserve independence, the cornerstone of dollar credibility since Volcker. The ruling didn't directly address Fed autonomy, but the legal theories it validated create uncomfortable adjacencies. If executive authority over financial emergency management extends to Treasury operations, debt structuring, and coordination mechanisms with the central bank, where exactly does Fed independence begin and executive authority end? The ambiguity itself is corrosive. Foreign central banks holding dollar reserves, China with over 1 trillion, Japan with similar amounts, smaller holders across Asia, the Middle East, and Europe, made those allocation decisions based on specific assumptions about institutional constraints. They assumed American debt was backed not just by taxing authority, but by institutional architecture that made certain outcomes unthinkable. Discretionary authority changes that calculus. Beijing's response is particularly revealing. Chinese financial strategists have spent years building alternative infrastructure, the cross-border interbank payment system as an alternative to SWIFT, bilateral currency swap arrangements with dozens of countries, the digital yuan as a future settlement mechanism. Western analysts often dismiss these as inefficient substitutes for dollar-based systems. But efficiency was never the point, insurance was. This ruling validates Beijing's strategy. It demonstrates that dollar infrastructure comes with discretionary political authority that can be invoked during crises. For countries concerned about sanctions, asset freezes, or financial pressure, that discretion is a vulnerability. China's alternative infrastructure investments just became strategically justified rather than economically questionable. European finance ministers face a different calculation. The EU's financial system is deeply integrated with dollar infrastructure, trade invoicing, reserve holdings, corporate debt issuance, derivatives clearing. That integration was built on assumptions about American institutional predictability. If U.S. financial crisis management includes discretionary authorities that could affect payment systems, debt instruments, or regulatory frameworks, European financial stability becomes partially dependent on American political decisions. Sovereign wealth funds operate on longer time horizons than most market participants. Norway's government pension fund, Abu Dhabi Investment Authority, Singapore's GIC, these institutions manage intergenerational wealth with investment horizons measured in decades. They're now reassessing what a world with discretionary American financial authority means for portfolio construction 50 years forward. The tactical signals are subtle but detectable. Credit default swap spreads on U.S. sovereign debt, theoretically insuring against default on the world's risk-free asset, have widened marginally. The move is small, but the direction matters. Long-dated Treasury yields show slight steepening that isn't fully explained by inflation expectations or growth forecasts. Currency hedging costs for foreign holders of dollar assets have ticked upward. None of these movements constitute crisis, but collectively they indicate repricing. Here's the game theory paradox. Discretionary authority can be both strength and weakness. If adversaries believe America possesses financial tools that can be deployed in crisis, that creates deterrence. But if they believe those tools undermine the institutional credibility that makes dollar dominance sustainable, it creates incentive to build alternatives. The Treasury market contains over $26 trillion in outstanding debt. Even marginal shifts in perceived risk create massive consequences. A 10 basis point increase in average borrowing costs, barely noticeable in daily trading, adds roughly $26 billion annually to debt service. Compound that over a decade of rolling over maturing obligations, and the fiscal impact approaches $300 billion. That's not theoretical, it's arithmetic. Foreign central banks have been the marginal buyers of U.S. debt for decades. They don't need to dump treasuries to change market dynamics, they simply need to slow accumulation. If China, Japan, and other major holders shift from adding $100 billion annually to adding $50 billion, that's $50 billion in reduced demand that domestic markets must absorb. Supply-demand imbalances in bond markets don't resolve smoothly. They resolve through price adjustment, meaning higher yields and increased borrowing costs. The reserve currency diversification trend predates this ruling, but the revelation accelerates it. Central banks aren't abandoning the dollar, they're reducing concentration risk. The International Monetary Fund's COFR data already shows gradual movement toward euro, yen, and yuan reserve holdings. This ruling provides strategic justification for accelerating that shift. It's not about replacing dollar dominance, it's about reducing dependence on institutional constraints now understood to be discretionary. Higher U.S. borrowing costs create a fiscal feedback loop. More budget allocated to debt service means less available for defense, infrastructure, research, and social programs. America already spends over $500 billion annually on interest payments, more than defense research and development combined. As that figure grows, fiscal constraints tighten, political pressure increases, and the temptation to use discretionary authorities intensifies, which further erodes confidence, which raises borrowing costs. The cycle compounds. Geopolitically, this matters because financial leverage has been a core instrument of American power. Sanctions work because global finance runs through dollar-based systems. Iran, Russia, North Korea, Venezuela all face economic pressure primarily because they cannot fully access dollar infrastructure. If that infrastructure loses credibility, if alternatives become viable, American coercive financial power diminishes proportionally. Europe faces a strategic choice it has postponed for years. The EU has discussed strategic autonomy, building financial infrastructure independent of dollar systems. France has advocated this particularly strongly. But inertia, integration costs, and lack of urgency kept the status quo. This ruling changes the urgency calculation. If American financial crisis management includes discretionary authorities that could affect European institutions, then financial autonomy becomes a strategic necessity rather than a theoretical preference. China's alternative infrastructure investments, the cross-border interbank payment system, the Asian Infrastructure Investment Bank, bilateral currency arrangements with over 40 countries, were often dismissed as economically inefficient. But Beijing was never optimizing for efficiency. It was building insurance against dollar discretion. This ruling validates that strategy and accelerates adoption by other countries seeking diversification options. Emerging markets that have experienced dollar-based financial pressure, Turkey, Argentina, Pakistan, Egypt, now have additional justification for diversification. The revelation that American financial constraints are more discretionary than institutional provides political cover for reducing dollar exposure, even when economically costly in the short term. Commodity markets present another dimension. Oil, natural gas, metals, agricultural products, global commodities are overwhelmingly priced and settled in dollars. That's not economic necessity, it's institutional convention built on dollar credibility. If that credibility erodes, the pricing infrastructure could gradually shift. Saudi Arabia discussing yuan-denominated oil sales isn't fantasy, it's rational hedging against dollar unpredictability. Multinational corporations are reassessing currency risk management. Treasury departments that assumed dollar stability as baseline now model scenarios where discretionary U.S. financial authorities affect asset values, payment systems, or regulatory frameworks. That modeling leads to operational changes, diversified currency holdings, modified hedging strategies, adjusted capital allocation. The alliance management challenge is particularly acute. U.S. allies, Japan, South Korea, Australia, European NATO members have integrated their financial systems with dollar infrastructure based on trust in American institutional predictability. For scenarios capture the range of plausible futures, each driven by different strategic choices and external pressures. Scenario 1. Effective institutional reassurance. U.S. policymakers recognize the strategic danger and take concrete action. Congress passes bipartisan legislation codifying fiscal constraints, making debt ceiling mechanisms automatic rather than discretionary, and establishing transparent rules for emergency financial authorities. The Federal Reserve issues clear communications reaffirming operational independence from executive influence. Treasury implements transparency initiatives regarding contingency planning and crisis management protocols. Senior officials engage diplomatically with major foreign reserve holders, Beijing, Tokyo, European capitals, Gulf states, providing reassurance about institutional constraints. This scenario requires what may not exist: bipartisan political consensus prioritizing long-term institutional credibility over short-term advantage. It requires mechanisms that credibly bind future administrations, which constitutional structures make difficult. And it requires time. Confidence erodes quickly but rebuilds slowly. Probability low, given current political polarization. Scenario 2. Gradual managed decline. Foreign central banks don't panic, they adjust incrementally. Reserve diversification accelerates from its current pace, but remains gradual. Treasury demand weakens slowly, pushing U.S. borrowing costs up 50 to 100 basis points over 5 to 10 years. America adjusts to diminished, but still substantial financial power, much as Britain managed its currency's transition from reserve status across several decades. This scenario unfolds through incremental portfolio rebalancing, not dramatic announcements. China reduces treasury purchases from $80 billion annually to $40 billion. European central banks shift new reserves toward euro-denominated assets. Gulf sovereign wealth funds slowly increase non-dollar allocations. The transition takes a generation, not a presidential term. Markets adjust. America remains financially powerful but less dominant. Probability, moderate to high. This represents the path of least resistance. Scenario 3. Accelerated de-dollarization. A triggering event, perhaps a severe sanctions dispute, a debt ceiling crisis where discretionary authorities are actually invoked, or a broader geopolitical realignment, creates urgency. China accelerates alternative infrastructure deployment, offering attractive terms for countries joining yuan-based settlement systems. Major economies begin conducting bilateral trade in local currencies or through Chinese systems. A financial coalition of the willing emerges. BRICS nations, Gulf states hedging American relationships, Asian economies reducing dollar dependence. Network effects that previously favored dollar dominance begin reversing. As more trade occurs outside dollar systems, the infrastructure advantages diminish. Tipping points exist in network-based systems. Gradual change suddenly becomes rapid when critical mass shifts. Early warning indicators would include sharp increases in CIPS transaction volumes, major commodity contracts denominated in alternative currencies, and coordinated central bank reserve diversification announcements. Probability, lower in the near term, but increases substantially if triggering events occur. Scenario 4. Weaponized financial discretion. The United States actually deploys the discretionary authorities the ruling validated, perhaps prioritizing bondholders during a debt ceiling impasse, invoking emergency powers to restructure obligations, or coordinating Treasury Federal Reserve operations in ways that blur fiscal and monetary policy. This validates every concern foreign holders had. Immediate repricing follows. Treasury yields spike. Capital flows reverse. The dollar weakens sharply. Every consequence discussed earlier accelerates dramatically. This scenario is most likely if political dysfunction forces crisis management through executive discretion rather than legislative resolution. It represents the worst outcome, confirming that institutional constraints were indeed optional, triggering the very flight from dollar assets that discretionary authority was meant to prevent. Probability: significant if debt ceiling or fiscal crises emerge without congressional resolution. What determines which path unfolds? U.S. political capacity for institutional reform, Chinese strategic patience versus opportunism, European investment in financial autonomy, and whether triggering crises occur. Market discipline still constrains discretionary authority. Using emergency powers carries immediate costs in higher borrowing rates. Path dependency in financial infrastructure creates inertia. Replacing dollar systems requires massive coordination costs. But the vulnerability is now visible and busy. The paradox posed at the beginning now resolves with clarity. A court victory exposed a weakness because the ruling didn't create the vulnerability, it revealed it. American financial dominance has always rested on a delicate equilibrium between overwhelming economic power and credible institutional constraint. The world didn't merely tolerate dollar hegemony because America had the largest economy or the strongest military. They accepted it because they believed American financial policy was bound by rules, norms, and institutional structures that operated independently of immediate political pressures. That certain things simply couldn't happen because the architecture prevented them. This ruling, regardless of its legal correctness or political merits, demonstrated that those constraints are more discretionary than the global financial system had priced in. The litigation exposed contingency authorities, validated theories of executive financial discretion, and made visible the gap between perceived institutional constraints and actual legal limits. In geopolitical competition, perceived weaknesses matter as much as actual ones. Once sophisticated adversaries understand that institutional constraints are negotiable rather than absolute, they will game out scenarios, build hedges, and construct alternatives accordingly. China didn't need definitive proof that dollar dominance was vulnerable to justify investing in alternative financial infrastructure, but this revelation accelerates timelines and increases resource allocation. History offers an instructive parallel. British pound hegemony didn't end with sudden economic collapse. It ended through gradual erosion of confidence that institutional constraints would prevent currency debasement, that fiscal discipline would be maintained, and that political stability would continue. Each small breach of perceived constraints accelerated diversification until network effects reversed and sterling's reserve status became historical footnote rather than current reality. This ruling doesn't determine America's financial future, but it fundamentally changes baseline assumptions. Markets, central banks, and geopolitical strategists are now operating with revised models that incorporate discretionary financial authorities they previously considered constrained. The critical question: can institutional credibility be rebuilt once it's been revealed as discretionary? Or has a threshold been crossed where alternative financial architecture becomes inevitable regardless of American efforts? Financial power is ultimately about trust, credibility, and predictability as much as aircraft carriers and GDP. Trump may have won this legal battle, but the revelation of discretionary financial authority may prove a strategic cost that outweighs the legal victory, not in this election cycle, but across the long arc of geopolitical competition where financial architecture determines who shapes the international order. The court ruling is over, but the strategic consequences of what it exposed are just beginning, and how America responds to this revealed weakness may determine the financial architecture of the 21st century.